As you'll likely recall, about 10 days ago, after Baidu had rocketed up here significantly, I shared a video where I suggested a possible paper trade for educational purposes where you would go and sell a call spread against Baidu. So this is what that call spread looked like. I sold this call spread. Now at the time, Baidu was trading down here at around 135, somewhere in that general area. So I gave it some room to run up a little bit further. But again, I sold that call spread up here. And at the time, I said, I suspect that Baidu will likely have a little bit of a pullback. And I was thinking the pullback might be down into this 116 range or so. Anyhow, a couple days later, Baidu did in fact have a pullback. At that point, I created a video where I recommended taking this Baidu trade and selling a put spread on the other side. So that's what was actually done, and I saved and shared that trade as well. And this is that trade. So what I want to specifically show you here is what an adjustment like that can bring to the table. So again, Baidu pulled back. If we take a look at our take a look at our chart here, Baidu pulled back to around the 124 range. So when we pulled back into that 124-ish range, I came and sold a put spread. What that did for me was that dramatically increased my max profit potential, and it reduced my overall risk in the trade. I split my risk between the two sides, really. So now I had $200 in downside risk, which I did not have before, and my upside risk was about $700 versus no downside risk here and upside risk of about $900. So by adding that put spread, when Baidu pulled back into here, I basically took off some of my risk here and I added some risk here. Now I did that because I could look at the chart pattern, and based off my read of the chart pattern, and this is not exact science, this is where more of the art of trading comes in. Based on my read, I was expecting a pullback. I felt like Baidu was overvalued. I was expecting a pullback of maybe that 50% range or so. So when that dip started to occur, that's when I chose to go in and add the put spread. And again, the key here, if we look at these two trades, is this is that original trade without adding that put spread on that pullback. And now I have, again, the 900 or so in risk, and my max profit is only 173. By adding that put spread when I did, I reduced my max risk to the upside. I increased my max potential profit by the amount I sold this spread for, and I did add in some downside risk. So at this stage, I like this position. Ultimately, it is a little bit risky. If I were to want to adjust it right now, I'm not going to. If I wanted to adjust it, I could potentially take this whole put spread and move it higher, turning this more into a butterfly trade. That would bring in additional premium into that trade. But again, not going to do that right now. That's not the purpose of this video. That would be a whole separate process. But I did want to share how and why sometimes layering into your trade or adding components to the trade at different times is a very valuable tool for options traders to know how to do. Having a tool like Option Strat here that allows me to model those different things dramatically helps me in understanding the different things that are available to me, the different types of adjustments, etc. So with that, I'm going to wrap up this video, but I will tell you over the next week or so, I do have some videos that I'm going to be sharing that are all about pattern recognition. They're about how to do technical analysis, understand chart patterns, things along those lines. They are excerpts from some educational content that I did for the largest broker in Canada a few weeks back. But I think they're very valuable learning lessons because you need to be able to understand the basics of reading a chart and doing technical analysis in order to be able to apply a tool here like Option Strat to help you out as best as it possibly can. So we'll see you in those episodes. Take care.